So chapter 12 is basically on planning for capital investments based on capital budgeting. We are going to be focused on the first two objectives as an introduction to that. And then other things that you have seen here or will see here, you will have definitely in a corporate finance and other class, which usually happens in the third year of business studies. So you will see more of this as we go. Learning objective one looks at, a capital budget. The capital budgets are for, investing in projects, in fixed assets specifically, right? So do we build this building? Do we buy this machinery, et cetera? Questions that know that you have to take a lot of money to do it, and you want to make sure that it's going to be worth it. So we basically have to calculate what's considered sort of a payback period, and you're going to learn a little bit about that here. Okay, but in essence, projects are needed. Departments have different needs. They do proposals. There's usually large corporations will have a committee that's focused in on all their capital budget requests and which projects are more worthwhile than others. They'll be ranked and sent to management for approval. And then that goes to the board of directors for final approval. So there's sort of a pecking order here. This is the illustration of it. These particular steps are used all the time. Okay, so it's a relatively good process at most large businesses. But for capital budgeting, even though you're going to be purchasing equipment or other fixed assets, how do we know how to evaluate the proposals? We rely very heavily on cash flows. They're the preferred inputs. Cash flowing in, cash flowing out. They're the preferred inputs to evaluate whether a project is worth funding or not. Why are we so focused on cash flow? Because basically it's something that we can track a value for and thus provide us with some concrete numbers to compare and make a judgment. Okay. So we look at a couple of things in terms of cash. The outflows, of course, we have to make that initial investment. So whether that's purchasing a relatively large piece of equipment or some other types of investments like that, this is the initial cost. There's always going to be maintenance and repairs that happen. This is how fixed assets work. You might have some increases in operational costs because you have this new equipment. And you might need to overhaul certain equipment. All of that requires cash going out for that investment. Cash coming in, right? You are going to sell the old piece of equipment. You're going to receive cash from customers because the piece of machinery or equipment you're going to buy is going to help you sell whatever you're selling. That might really reduce your operating costs if it's very efficient, which would save money, keep money in the business. And then when you're done with this, will it have any salvage value? Because that could be part of that sale for the next round. Okay. So capital budgeting decisions depend on a lot of different factors. One of the more important ones is, does the company have money to invest? It's going to be competing with a lot of different projects. So are those projects related, which is going to have a larger impact on the company? Those types of things are factored in the decision as well. The company has its own culture and how it makes decisions on these types of things. So that's going to be a factor. And one of the things that you'll learn a lot, you talk about it, particularly in your corporate finance class and as a junior year business major, is risk and the needed return on. If you're going to take certain risks, you're going to need a more solid return to take that risk. So risks are associated with projects are very important. So here's an illustration on how it would, how something like this would work. Let's say you have Stewart Shipping Company. They're considering purchasing a new piece of equipment for $130,000. So that's money that's going to be money that they're going to need to invest, right? They believe that this equipment is going to have a useful life of 10 years and have no salvage value at the end of that period of time. Okay, so that's an important piece of data to start with. What about the cash flow? Well, this particular investment is going to increase cash flows from customers by $200,000. So we're going to have 200 coming in. However, it's going to require, right, maintenance and operating costs of 176. So there's 176 going out. So the net cash flow is going to be $24,000 per year. Okay, these are annual, so this is per year. You're going to be receiving. So you're forking out 130,000 for a piece of equipment that's going to last 10 years, and you're going to see your annual cash flow increase by 24,000. So how do we know if that's a good deal or not? One way we can check is we're making a 10-year commitment to this equipment, but how quickly are we going to be getting back our cash, right? So the cash payback technique really identifies that time period for these investors, for the company to look at it. And they basically, it's a very simple formula: the cost of the investment divided by its net annual cash flow. That'll give you the payback period. So remember, the cost of this new equipment was $130,000. It was going to produce $24,000 in net annual cash flow to the company. And so its payback period would be just under 5.5 years, right? Well, that could be very good because this is a 10-year. They're hoping to use this equipment for 10 years. And so they're going to get their money back in 10 years, in 5 years, a little over 5 years. In essence, the shorter that is, the more attractive the investment is for the company to do. Okay, but this is assuming the first case, assuming that that's a regular cash flow, 24,000 a year every year for 10 years. Most investments have what we call an uneven cash flow. Some years the cash flow coming in will be better than other years. So what happens, how do we determine a payback period when there's an uneven cash flow? Okay. So we look at the total, the cumulative net cash flow from the investment. And we look at when it actually equals the cost of the investment. At that point, we have our payback period. So how does it work? Here's an example when you had Chen Company propose an investment for a new website that cost them $300,000. So the investment up front is $300,000. That's the investment up front. As you see here, it's going to have uneven cash flow. The first year, the net cash flow is going to be 60. The second and third year, it's going to be 90. The fourth year, it's going to be 120,000 in net cash flow. In the fifth year, 100. So this is the unevenness, right? It's not that nice little equal 24,000 a year for 10 years. Right? It's uneven. So then how do you calculate your payback period? Well, that's what the cumulative net cash flow is. You're simply totaling these as they go. So 60,000 the first year, that's how much it's accumulated. Another 90,000 in cash flow in the second year. Now you have 150 in cumulative cash flow. Third year is another 90, so now we're up to 240. After the third year, we have 360. So clearly the investment was 300. So somewhere in between the third year and the fourth year, we equaled out, right? So how do we know how long it takes? Well, you have you're at 240,000 after 3 years. You need to get to 300,000. So you need 60,000 more. 60,000 more. You had 120,000 for cash for that year. So basically, halfway through the year, 6 of the 12 months, you will break even. You will have your payback, the $300,000 back, which means technically this will happen in 3.5 years. So the payback period is going to be 3 years and 6 months, simply by using the fraction. 3 years and 6 months is 3.5 years. Okay, but it's simply you're at 240. You need 300, so you need 60,000 more to break even, right, to get your cash back. But at the end of the year, it's 360. So you simply take the 60 divided by the difference here is 120. All right, so 6 months over 12 means by July 1st or June 30th, you've broken even, you've gotten all your cash back. So that's the first thing here for the do it exercise there for number one. It's about that payback period. I don't think it's very difficult to figure out. The real trick here is the second learning objective, as you'll see. So here we have a paper company. They're considering adding another machine, right, to manufacture corrugated cardboard. The machine would cost $900,000, has a 6-year life, no salvage value. They believe that the inflow of cash will go up by 40,000, and the outflow would go up by 190,000. So the net cash flow, the difference, will be 210,000. Right? So in essence, they have the 210,000 as the net cash flow. You will divide that into the original cost, and your payback period is simply going to be 4.3 years. So after 4.3 years, you will have recovered your entire investment. Okay, that's going to last for 6 years. So that is learning objective one in a nutshell. Again, not terrible. Math is relatively straightforward, pretty easy. Learning objective two is the harder one. This is where you're going to be spending a little bit more time. And one of the things that are going to help you here is going to be in the appendix. The present value tables in Appendix A are going to be useful. I think they're tables 3 and 4 in the appendix. They're going to be useful here. Okay. So one thing that we have to look at is, as your book explains, we need to take into effect the time value of money and the estimated cash flow. Right. So how do we do this? We need to have a technique to do it. We call it discounted cash flow technique. And the methods that are used to calculate this include net present value, which we're going to focus on. This is a learning objective 2. This is the focus of this objective here, which is the focus of, which is where we're stopping. You can also use internal rate of return. This is later in the chapter, learning objective 4 or 5, that we're not going to be focusing on. We're going to focus on the first one. If you get the first one, you'll get the second one. So of those two methods, net present value is going to be the focus. So remember, we're going to be having inflow of cash for a period of time. If we're expecting, even for that first example, If you're expecting $24,000 a year for 10 years, okay, so at least you know what your constant rate of cash. But what's their present value? What's the present value of that? Right? Because $24,000 today in cash flow is going to be different. It's going to be worth 24,000. However, but 24,000 10 years from now isn't worth 24,000 today. How much is it worth today? That's the present value issue. And so we use a present value table to discount that, to bring it to the current dollar amount. So then we can compare to how much we're investing today, because we're investing something today for this future flow. So how much is that future flow worth today? So we can compare the two today. Okay. So that's basically what this method is. Okay. The interest rate that we use in the discount is whatever we are required to have as a minimum rate of return. Okay. If we compare the layout or the outlay, sorry, of money today with our cash flow over time, and that cash flow is greater than our layout or outlay, then that proposal is good. It's going to bring money in, and so we should accept it. However, when we compare what we're putting out today in terms of capital to the present value of all those cash inflows over time, and it's less, then it's probably not a good idea to do it because we're losing money. We wouldn't want to do that. So in essence, the higher the net present value, the more attractive the capital investment would be to the business. So the illustration looks at how they would analyze things. The first thing they look at is the present value of the cash flow. So whatever the net, remember that net cash flow is going to be cash flow every year for a number of years, right? They just look at the present value of that cash flow. Right? Like I said, $24,000 today is worth $24,000. How much is $24,000 in 5 years from now worth today? Present value. Okay, bringing future money into the present. So we take that present value of that cash flow, we compare it with how much we're going to invest. Okay, the comparison should yield what's called the net present value. If that's positive, then we should do it. Even if it's zero, we're not losing any money on it. We should do it. If it's negative, then it's not something we would want to do. Okay. So here's the illustration. Let's go back to steward shipping. And remember, steward shipping had annual cash flows of $24,000 a year for 10 years. Okay. Now, when you look at the present value tables, you will see a factor, okay, listed. What you want to do is look at the interest rate that we're talking about and the time period. And where they intersect, that's going to be the factor that we're going to use. Okay. So the present value factor over 10 years at 12% is 5.65022. This comes from the book. We multiply that by the cash flow. So we have a $24,000 annual cash flow, and the present value of those cash flows, the factor would be 5.65022, which means that the present value of the entire cash flow, 24,000 a year for 10 years, the current present value is 135,605. So this is important. This is our starting point. We compare that to what we actually spent. So we just calculated that the present value of the cash flow is 135,605. It would have cost us $130,000 to make that investment. Since the cash flows, the present value of the cash flows is greater than the capital investment, our net present value is a positive 5,605. As long as it's positive, this is a good thing to do. Okay, it's a good thing to do. So in this case, they should accept it. It is acceptable. Why? Because the net present value of those cash flows compared to the investment up front is greater. It's positive. So this is how we would calculate the present value of that project compared to how much it costs in the investment. Again, if it's positive, we do it. It's acceptable. What if in this case we still expected $24,000? Well, 10 years over 24,000 over 10 years is 240. So let's say Stewart is still expecting $240,000 over the life of that investment. However, the net cash flows are higher in the early years and lower in the later years. In other words, it's going to be an uneven cash flow. The cash flows up in the early years 1, 2, 3, 4, 5, right, are going to be high, and the later years 6, 7, 8, 9, 10 are going to be low. So should they do it, knowing that the cash flow is going to be uneven? Well, in this case, we're going to have to note what the cash flow is. So here they actually give you what the cash flows are every single year for that 10-year period. Notice they're still going to get a $240,000 cash flow over 10 years. It's just that it's uneven flow, right? The beginning years are going to have higher levels of cash coming in. The later years are going to have lower levels of cash coming in. Well, then we have to look at the discount factor at 12% for each of these periods. So the discount factor of 12% for 1 year is 0.89268. We multiply that across to get its present value of 30,356. Okay. And we have to do that with every single year, except it's 12% at 2 years. That's that factor. 12% at 3 years is this factor, and so forth and so on. You multiply each line across to get your present value. Add them all up. That's your total. So now the total of the cash flows are 144,000. Even with uneven cash flow, your total present value is 144. Remember, this only cost you 130,000 to do. Even with uneven cash flow, going higher in the early, lower in the later years, the net present value is still positive. Matter of fact, it's greater than just that steady cash flow. So this is even a better deal. In essence, it's still very, very acceptable because the present value of those cash flows is much higher than the initial investment. And so, yes, they should do it. They should do it. Okay. Either way, whether it's steady, $24,000 a year for 10 years, steady every single year, or whether it's sort of uneven, like what you just saw, both of them are evaluated with net present value, showing it's greater, right? And so they're both acceptable proposals either way. Of course, we're calculating things about the future. We really don't know what's going to happen, right? So this is our best way of guessing whether it's a good idea or not. How do we actually come up with that rate of return, required rate of return? How do we come up with that? Well, basically, how much is the cost of capital? It's going to be at least the cost of capital or higher for it to be worthwhile, right? So if you're going to borrow money in a loan for 9%, you better have a required rate of return of 9% or greater to make it worthwhile, right? That's basically how they come up with this type of stuff. Where do they get the capital? Again, they get it from creditors, they get it from stockholders. Either way, there's a cost to getting capital into the company. That's what they use oftentimes is that required rate. What's missing often is the issue of risk. The issue of risk, because most corporations, when they calculate these, they're focusing on a required rate of return, which may not necessarily be a good number. In other words, the project might be riskier than what they think, and the required rate of return should be higher than what they've calculated. So risk is one of those unknown factors that they're guessing. They're guessing. When you look at the cost of capital and the risk, we would call that the discount rate in finance. The discount rate is also known as required rate of return, the hurdle, or the cutoff. But they all mean the same thing. They're all talking about if we borrowed money to do this, make this investment, what's the required rate of return we need to make it worthwhile? Okay. So let's take a look at another illustration where, well, actually, it's the same illustration as Stewart Shipping. Remember, they used a discount rate of 12%. But what if the project was more risky? What if they should have used 15% instead of 12? Okay. Well, as you know, when you looked at 12% for 10 years, you've got a factor of 5.65022. So when you multiply that by the $24,000 per year for 10 years, you've got 135,000, right? Compared to the initial investment, meaning that it's a positive, it's greater than, so they should do it. What if you looked up the factors if it was 15%? What if it was riskier? What if they required a higher rate of return? Well, that factor, 15% over 10 years, was 5.01877. So if you take that $24,000 a year and multiply it by that factor representing a higher risk, that would only come out to be $120,450 in the present value of the investment compared to the $130,000 it costs, which means this investment is too risky. It's not going to pay off. When it's below zero, when it's a negative net present value, it's not going to pay off. It's not worth the risk. So don't do it. Unfortunately, all these models are just that. They're models. They're financial models. We have to have ways of trying to comprehend things, and we're trying to project things in the future that we just don't know. So these models are not perfect. They are based on certain assumptions. One is that all the cash flow is going to come in at the end of the year, which is, of course, not the way it happens in reality. It comes in at various times. Another assumption they make is that when we do get the cash flow, it's immediately reinvested in another project that has a similar return, which, of course, that's also kind of a fantasy because we don't know what the rates are going to be and whether they're going to be higher or lower. We can still make and reinvest, but we just don't know. Can't predict that. And cash flows are certain. And of course, that is definitely not part of reality because sometimes it doesn't pay off. Sometimes it's uncertain. The whole future really is uncertain. So, but these models have to be made with assumptions and to help us understand whether the company should make that investment or not. Okay. Um, so here is a question that you're going to have for your homework here. I'm going to get into the do it exercise to get into this. Here's a more complex, comprehensive type of example. Here we have best taste foods. Best taste best, never know. They're considering investing in new equipment for fat-free snacks. It's funny how all that fat-free stuff makes you fat, though. The initial investment of that equipment is $1 million. Okay, so that's upfront. The cost to overhaul that equipment in 5 years is another 200,000. After we're done 10 years, the salvage value will be 20,000. The cost of capital, which is again the discount rate, 15%. So it's pretty high. Here is the cash flow. We have cash inflows of $500,000. We have cash outflows for 200,000. We also have maintenance, which is directly related to that equipment, for 30,000. What we don't know is how much of these direct operating costs are part of that. They just could also just be fixed costs. So that may not be a factor, but we're going to include them in. What's the difference? Well, you take the 500,000, subtract the outflows and the costs. So that means the net cash flow, I'm doing my math correct, is $240,000, right? 230, right? 500 minus these, correct? All right, so that's going to be the basis of calculating our net present cash flow. So let's do it. Oh, it was right. Okay, it's 230. That's our net annual cash flow. Of course, this is going to be going on for some time, right? We're going to buy a piece of equipment for $1 million. We're going to overhaul that equipment in 5 years for $200,000. The present value of that $200,000 is only $99,436. So we're going to end up putting out a little over $1 million for the purchase and overhaul. The cash flow, as you saw, was $230,000 a year for 10 years. Since it's going to be stable, you simply look up the factor, 15% for 10 years, you got 5.01877. Multiply that by the $230,000 cash flow, and that means you're going to get 1.154 million in annual cash flow. And you got salvage value, which means you're going to end up, you can sell that for 20,000 at the end. And so here, if that's going to happen in 10 years, the factor for 15% at 10 years is 0.24719. So that means in present dollars, it's worth $49.44. So the net present value is the difference, right? You're taking the difference between the positive numbers and the negative numbers here, and that's going to show up as a whopping 59,825. So this is looking like it's going to be very acceptable to do. Okay. Again, positive net cash, net present value. You're gonna do it. So the do it exercise at the end here looks at Watertown paper. They want to add another machine to manufacture corrugated cardboard. The machine costs 900 grand. It has a 6-year life, no value, no salvage value. Cash inflows up by 400,000. Cash outflows up by 190. Management has a required rate of return of 9%. So let's see whether this should be accepted or not. So we have cash inflows of 400, cash outflows of 190. So our net cash flow would be 210,000. We're going to have this over a 6-year period of time at 9%. So when you look at the factor from table 3, present value tables are table 3 and 4. 4.48592, which means our present value of our cash flow is 942,000. It's going to cost us 900,000 to buy the machine. So that means that our net present value is positive. So we should be doing this. So that's what's coming at you today. It's not that bad. It takes a little bit of time to get used to it. But I'm not going to pepper you very hard on this, but you'll have a few to do. Okay.